Hi, everyone, and thank you for joining us again on another educational series that we're putting on here at Gifford Carr. Pleased to be joined today with Bernie Robertson, who's our branch manager in our North Bay office. Bernie has been in the industry for longer than we care to admit, but he is widely respected as one of the foremost experts in mining insurance, and that's really what we're going to talk about today. So thanks for joining today, Bernie.
Thanks, Matt. I appreciate the opportunity to glean some information to the general public and to our clients as well.
Absolutely. So Bernie, there are 5 main areas of concern, not only to drilling contractors, but to mining companies, some contractors, suppliers. We're going to go through the questions and things that clients and policyholders should be looking at and reviewing, and if not, should be having a conversation with you as to how we can properly mitigate their risk and properly insure them. So I'm going to start off with, does my policy cover my operations in the event of a fuel spill on land or water, ice that mitigates to a third party's property?
Well, Matt, when you own property, whether or not you're a mining contractor or a subcontractor or a drilling contractor on the site, you're liable for any release of a contaminant or irritant that migrates to a third party's property. In other words, a drilling operation, exploration drilling going on at a site, and it migrates into an adjacent stream, the processed water, or the mud, as it's called in the drilling industry, then you can be held responsible by the Ministry of Environment. And the problem is that in many of the jurisdictions in Canada, the laws are not consistent on what is considered to be the volume of an irritant or contaminant where it needs to be cleaned up. But ultimately, as a owner of property, you're responsible for the damages and any associated cleanup and any fines and penalties that could be associated with that.
And how hard is it, Bernie, for companies who are taking over a mine to prove that it was potentially the previous mine, or that it wasn't actually their responsibilities? Like, this is something that I can't see being an easy thing for companies to mitigate. So ultimately, if you're buying the mine, you're buying the past problems.
Yeah, because traditionally in most insurance policies for environmental coverage for environmental impairment will not cover pre-existing conditions. So you have to be eyes wide open when you're purchasing an asset to make sure that if there's any reclamation, that it's already been accomplished. And if you're contractually going to take on that obligation, you better be you better have some money in the bank to be able to do the remediation before you assume it, because once you buy it, it's buyer beware, you own it.
So then, Bernie, what are the legal implications of buying a property that have past pollution exposures?
So Matt, under the Canada Corporation Act, as a director and officer of a corporation, you have an unlimited liability in 3 areas: tax, environmental, and employment practices. While we're speaking about environmental, and the corporate shield can be penetrated, and you can be held personally responsible as a director of a corporation if you don't have the appropriate coverage in place for environmental impairment liability.
Bernie, if I'm drilling beside an existing mine working, if operations cause a collapse below surface, am I covered for damage and injuries to any underground employees or other workers?
Well, Matt, that all depends on the policy wording itself, because in a lot of cases, most general liability policies that exist in Canada have an exclusion for collapse while underground. So what that means is that for any property damage or bodily injury that you cause as a result of working on surface, you better make sure that exclusion isn't in there in the policy wording, because it could potentially forfeit insurance for any collapse that potentially causes underground. For example, a diamond drilling contractor is doing exploration drilling beside an existing mine working. If they hit a pocket and cause a collapse underground and bury the mine shaft or cause an explosion and injure people, then there's going to be a problem, because if your policy has that exclusion, you have no insurance.
Is my surface or underground equipment covered in transit from the yard to the job, and at what value?
Well, Matt, that's an interesting question, because once again, the policy wording dictates as to what the conditions are. But the problem is that if you're in contract with a common carrier to move your load, then you have to find out from them what they're insuring it for. Are they insuring it on a price per pound for the load that they're hauling, or are they covering you on an agreed value? So again, contractually, you have to make ensure that if you are using common carriers to move your equipment, that you have those values declared and it's very clear and contractually on who's responsible. Common bill of ladings, once again, as long as they're being used, the worst case scenario is when you come back to the insurer and say, well, we didn't have a standard bill of lading or we didn't have a written agreement, then it's going to go back, it's going to defer back to price per pound. And that's when the issues are going to begin.
All right. Bernie, when I refurbish my equipment at my shop, does that money spent on refurbishment factor into the loss settlement if the equipment is destroyed in transit back to work or to a customer's site?
Well, loss settlement under the traditional insurance policies, Matt, covers the equipment on either actual cash value or replacement cost basis. Traditionally, replacement cost is if the unit is within 3 to 5 years of age. But anything older, traditionally the insurance company will depreciate that asset. So here's the problem, is that if you have an asset that you've brought back in your normal rotation and you're servicing it and bringing it up to speed to send it back out again, how much is that value? Can that be factored into a loss? So if you're in transit back to the site and the equipment is overturns and is damaged beyond repair, what's going to be the ACV payout to the insured? Will it include that betterment or refurbishment value of, could be 50, 100,000, who knows?
And is that something you add on to the policy, or is that strictly the value that we bring in terms of having that negotiation, I guess, with the adjuster or on behalf of the client when it comes time to a claim payout?
Well, the best settlement basis is to look to have the policy amended to not only cover ACV, but any betterment supported by invoice. So our recommendation is that you deal with an insurer that will provide an ACV policy on older equipment, including any betterment, but again, supported by an invoice, a shop invoice that would show how much money was actually put into it. And that way, again, if that agreement's done up front, it's a lot easier when it comes to loss settlement if that agreement's already in place.
Bernie, what are my obligations with respect to helipads and slinging of loads on drill sites or camps?
Well, Matt, once again, that goes back to the contract. Traditionally, when you need to use fixed wing aircraft or rotary aircraft, helicopters, to get to a mine site because it's in a remote area, then the owner of the mine or whoever owns that site traditionally subcontracts the helicopter contractor or the fixed wing contractor to bring staff and equipment to site. So in almost all CGL policies that exist in Canada and even internationally, they exclude the peril of anything related to aviation because there is separate coverage available for that. So here's the dilemma, is that if our contractor or subcontractor builds or maintains a helipad on behalf of the mine owner, what is the contractual obligation? Because again, if our liability policy excludes aviation related incidents and we get named in a lawsuit, we have to have some sort of ability to defend ourselves. And the policy, based on what's available in the market, will not respond unless you have purchased an additional extension for non-owned aviation and helipad maintenance.
Gifford Carr Insurance Group is a resource-focused insurance brokerage. In conjunction with underwriters at Lloyd's of London, we have designed specific programs to service the junior intermediate mining companies and contractors that support the mining industry as a whole.
After you've addressed these questions that we've done in this series, if you don't know how much risk you're accepting contractually, we need to talk.